Welcome to this explainer on the Rio Tinto Group, arguably one of the world's absolute titans of mining. Today, we're going to examine their record-breaking first half of 2026. But more importantly, we want to dissect whether this massive momentum is actually sustainable over the long haul. We've got a really fascinating story today about a legacy company undergoing a radical transformation, so let's dive right in. Now, before we really get into the weeds, just a quick reminder that this explainer is strictly for informational and educational purposes. It doesn't constitute financial advice. All the views we'll be discussing are based on publicly available information and analyst reports as of August 2026. And as always, past performance doesn't indicate future results. All right, here's our roadmap for today. First, we'll cover their massive financial wins, then their strategic pivot to green energy metals, their future growth projects, a deeply divided market valuation, and finally, the critical risks hovering on the horizon. Section 1. Record-breaking financial results. Starting right at the top line, CEO Simon Trott categorized this period as a major step change, and the numbers back him up. Consolidated sales revenue hit a staggering $31.03 billion. That is up 15% year over year. In the world of mega-cap mining, moving the needle 15% on your top line is a huge achievement, heavily driven by strong commodity prices and just relentless productivity. Moving down to profitability, the underlying EBITDA jumped 28% to $14.8 billion. So they aren't just selling more volume, they're operating significantly more profitably while they do it. And the bottom line, net earnings surged an impressive 47% to $6.7 billion. Think about that for a second. When a legacy mining company almost increases its net earnings by half in a single year, the market absolutely pays attention. The crucial point here is that this financial win isn't just paper profits. It's driven by incredible, on-the-ground operational execution. They achieved their highest first-half Pilbara iron ore output since 2018 at 162.3 million tons. That efficiency led to free cash flow climbing a substantial 75% to $3.8 billion. The return on capital employed improved to 17%, and shareholders were rewarded with a very healthy $3.4 billion interim dividend. Basically, they're firing on all cylinders. Section 2. Beyond just iron ore. To really understand where this company is headed, we have to look under the hood at a rather surprising structural shift. For decades, Rio Tinto has been entirely synonymous with iron ore. But today, for the very first time, nearly 60% of their underlying EBITDA comes from copper, aluminum, and lithium. The green transition metals are officially driving the bus now, fundamentally changing the entire narrative of this iron ore giant. And the growth in these sectors is rapid. Copper EBITDA is up 84% in the first half of the year alone, and aluminum is up 31%. Capitalizing on this momentum, leadership is pushing a strict mandate to make the companies stronger, sharper, and simpler. They're targeting a $1.8 billion annualized productivity run rate by the end of 2026, and they plan to release anywhere from $5 to $10 billion in capital through asset sales and aggressive cost reductions. They're making sure every single dollar competes for capital. To actually execute this streamlined vision, they completely reorganized the company's structure in August 2026, boiling everything down to 3 core businesses. Matthew Holdse's integrating the massive iron ore segment. Katie Jackson is steering the surging copper division. But perhaps most notably, they've essentially married their emerging lithium division directly into the aluminum product group under Jérôme Pécresse. Section 3. The Future Growth Pipeline. A corporate pivot of this magnitude requires multi-decade mega-projects, and their roadmap maps out the major milestones defining Rio Tinto's next 10 to 12 years. Right now, in 2026, they're launching 5 to 10 million tons of initial sales from the Simandou iron ore project in Guinea, while fully operationalizing their $1.5 billion AP60 aluminum smelter expansion in Quebec. Fast forward to 2028, they aim to hit 200,000 tons of lithium capacity. By 2030, they're targeting 1 million tons of annual copper production. And looking all the way ahead to 2038, they've just secured a deal to run Australia's largest aluminum smelter, Tomago, on 100% renewable power. Section 4. The Great Valuation Debate. Now, with record earnings and a stacked growth pipeline, this sounds like a guaranteed slam dunk, right? Well, despite those milestones, the market is completely divided on how to value this transformation. Looking at the consensus from 16 major brokerages, analysts collectively rate the stock as just a lukewarm hold. We've got 3 sells, 6 holds, and 7 buys or strong buys. This showcases a very deep split in market confidence regarding its recent $101.89 share price. The street literally cannot agree on what this company is worth right now. This tug of war is playing out in real time. Just looking at the rating actions from August 2026, you have highly bullish upgrades from Goldman Sachs and Berenberg setting aggressive price targets, fighting directly against a wave of valuation downgrades from RBC Capital, Bank of America, and Morgan Stanley. The very heart of this conflict stems from a fundamental disagreement in valuation methodology. If you use a traditional fair value estimate based on current multiples, the stock looks modestly undervalued at roughly $75.50 on the London Exchange. But if you run a discounted cash flow model, projecting out the actual cash they're going to generate in the future and discounting it back, that model insists the stock is vastly overvalued at just $53.81. That is a massive discrepancy. Section 5. Key risks and outlook. So why is the future cash flow model so deeply pessimistic compared to current earnings? Well, first and foremost is their unavoidable exposure to China, which accounts for roughly 60% of their total sales. Bank of America specifically downgraded the stock because China's credit impulse, which is essentially the flow of new credit into the broader economy, has turned negative. And historically, mining stocks significantly underperform with a 6 to 8 month lag when that happens. Second is the immense macro pressure on their legacy business, iron ore. RBC Capital projects that global iron ore prices are going to drop to $85 per ton by late 2027. Even with their big green metal pivot, a price drop that severe would heavily squeeze Rio Tinto's overall margins. Third, we have to talk about geopolitical and execution risks. Transforming a massive company requires absolutely flawless execution on these mega projects. Delivering the Simandou project in Guinea or ramping up the underground Oyu Tolgoi mine in Mongolia requires navigating highly complex, constantly shifting regulatory and political environments. These are incredibly capital-intensive projects, and any delays are extremely costly. Finally, grounding all of these high-level financial metrics and projections is a very sobering reality check from leadership regarding human safety. At the 2026 AGM, both CEO Simon Trott and Chair Dominic Barton noted that 3 tragic fatalities have occurred across their operations since the previous year. They made it abundantly clear that safety is the fundamental foundation of the business, and that level of risk must be completely eliminated before celebrating any financial win. So, putting it all together, Rio Tinto is undeniably transforming. They're successfully executing a massive pivot from a legacy iron ore miner into a diversified green energy giant. And their first half numbers prove they have the operational strength to actually do it. But I'll leave you with this provocative thought to consider as you dig deeper. When assessing a legacy giant right in the middle of a major transition, which valuation lens do you trust more when the future cash flows and the current multiples completely disagree? Thanks for joining this explainer, and keep learning.